If you have bad credit and you've been approved for a car loan, or you're looking at getting one, you've probably seen the interest rate and had one of two reactions. Either you didn't really understand what it meant, or you understood exactly what it meant and it made you angry. Both of those reactions are valid. Subprime interest rates are high. There's no sugarcoating that. But here's what most people don't understand: why they're high, what they're actually costing you in real dollars, and most importantly, what you can do about it over time. I'm Gary, the bad credit car guy, 26 years as a general manager of an independent used car dealership. I've sat across from thousands of customers who had questions about their interest rate. In this video, I'm going to give you straight answers: what your rate means, how it affects your total cost, and exactly what steps you can take to get a lower rate when it's time to refinance. Let me start by explaining why subprime interest rates are as high as they are, because understanding the why makes everything else make more sense. When a lender approves a car loan, they're taking a risk. They're betting you're going to make your payments for the life of the loan. The higher the risk they perceive, the higher the rate they charge to compensate for that risk. With a prime borrower, someone with a 700 plus credit score, stable long-term employment, and a clean credit history, the risk is low. The lender charges a low rate because the odds of getting paid back are very high. With a subprime borrower, someone with a lower score, some credit challenges, maybe a shorter job history, the lender sees more risk, so they charge a higher rate. That higher rate is how they offset the possibility that some percentage of subprime loans will default. It's not personal, it's math. Now here's what I want you to understand. A high interest rate on this loan does not mean you're stuck with a high interest rate forever. This loan, if you manage it right, is the first step toward a lower rate on your next loan. I'll get to that at the end of this video. But first, let me show you what your interest rate is actually costing you in real dollars, because most people have never seen this broken down clearly. Let me give you some real numbers so you can see exactly what your interest rate means for your total cost. Let's say you're financing $10,000. That's a pretty typical amount financed on a subprime deal. At a 24.9% APR over 48 months, your monthly payment is about $320. By the time you make your last payment, you will have paid back about $15,300 on a $10,000 loan. That's $5,300 in interest. Now let's look at what happens if you could get that rate down to 18%. Same $10,000, same 48 months. Your monthly payment drops to about $293. Total paid, about $14,000. Total interest, about $4,000. That's $1,300 in savings just from getting your rate down 6%. And if you could get down to 12%, which is achievable after you've built some positive credit history, your monthly payment is about $263, and your total interest drops to about $2,600. That's a difference of over $2,700 in interest between 24.9% and 12% on the same $10,000 loan. This is why your interest rate matters. And this is why refinancing when you've built some positive history is one of the smartest financial moves a subprime borrower can make. And speaking of that, check out the free auto loan calculator on my website at badcreditcarguy.com. You can plug in your own numbers and see exactly what your rate is costing you and what a lower rate would save you. The link is in the description. So how does a lender determine what rate to give you specifically? It comes down to a few key factors. First, your credit tier. In video 4, I broke down the 4 credit tiers: prime, secondary, subprime, and deep subprime. Each tier has a rate range associated with it. The lower your tier, the higher your rate. Moving from one tier to the next, even just 20 or 30 points on your score can mean a meaningfully lower rate. Second, the loan term. Longer terms often come with slightly higher rates in subprime because the lender is taking on more risk over a longer period. A 72-month loan typically carries a higher rate than a 36-month loan from the same lender. Third, the vehicle. Lenders look at the age and mileage of the vehicle you're financing. An older high-mileage vehicle is a higher risk collateral. If they have to repossess and sell it, they get less money back. Some lenders charge a higher rate or won't finance older vehicles at all. Fourth, your specific credit profile. Beyond just your score, your recent payment history, open collections, time on the job, income stability. All of these factor into where within a tier's rate range your specific deal lands. Your finance manager is working within the rate the lender approves for your specific deal. They don't set the rate. The lender does based on all of these factors. Now, let me tell you something that most finance managers won't, and that's the concept of dealer markup on the interest rate. Here's how it works. When a lender approves your deal, they give the dealer what's called a buy rate, the minimum rate the lender will accept for your deal. The dealer is then allowed to mark that rate up by a certain amount, typically 1 to 3%, and keep the difference as additional profit. So if your buy rate is 22% and the dealer marks it up 2%, you're signing at 24% and the dealer is earning additional income on that spread. This is legal and it's standard practice in the industry. I'm not telling you this to make you angry. I'm telling you this so you understand that the rate you're quoted is sometimes negotiable. If you've done everything right, clean application, solid down payment, stable income, and you feel the rate you're being quoted is too high, it's okay to ask the finance manager if there's any flexibility on the rate. They may say no, but sometimes there is room. At minimum, knowing this exists means you're walking in informed, and informed buyers get better deals. Now let's talk about the most important thing, how to get a lower rate. The answer is refinancing, and here's exactly how to do it. Refinancing means replacing your current loan with a new loan at a lower rate. You keep the same vehicle, you just get better terms. Here's the roadmap I'd give any subprime borrower who just got approved. Step 1. Make every payment on time for the first 12 months. No exceptions. Every on-time payment gets reported to the credit bureaus. After 12 months of consistent payments, you will have established a positive payment history on your biggest monthly obligation. That moves your score. Step 2. Don't apply for a lot of new credit during that time. Every hard inquiry temporarily lowers your score. Be disciplined. Let your auto loan do the work. Step 3. At the 12-month mark, check your credit score. If you've been making payments on time and your score has moved, even 20 or 30 points, start shopping for a refinance. Step 4. Go to your bank or credit union first. Once you have 12 months of positive payment history on an auto loan, many credit unions will work with you at significantly better rates than what you have now. Credit unions in particular are known for being more flexible with members who can demonstrate improved credit behavior. Step 5. When you refinance, make sure the new loan is worth it. Look at the new rate, the new term, and the total interest you'll pay. Sometimes a slightly lower rate on a longer term actually costs you more total money. Run the numbers. Use the calculator on my website. The goal is to use this first loan to build the credit history that gets you a better loan next time. That's how you break the subprime cycle over time. Before I close, let me tell you a few things not to do when it comes to your interest rate. Don't obsess over the rate to the point where you walk away from a deal you actually need. A 25% rate on a reliable vehicle that gets you to work is better than no vehicle at all. The rate is temporary. The transportation is immediate. Don't extend your loan term just to lower your monthly payment without understanding what it costs you in total interest. A lower payment that doubles your total interest cost is not a good deal. Don't fall for credit repair companies that promise to lower your rate right now. Nobody can do that except your lender, and only through a legitimate refinance after you've demonstrated positive payment behavior. And don't miss a payment trying to save up for a refinance. Your payment history is everything, protected above all else. Your interest rate is high right now because of where your credit is right now. That's not permanent. Every on-time payment moves you closer to a lower rate. And over 12 to 24 months, the difference is real, money in your pocket. Use this loan right. Make every payment. Watch your score move. And when it's time to refinance, you'll be ready. I'm Gary, the bad credit card guy. 26 years in this business. Real information from real experience. Don't forget to check out the free auto loan and amortization calculator on my website, badcreditcardguy.com. Plug in your numbers and see exactly what your rate is costing you and what a refinance could save you. Grab the free guide in the description, The 7 Things Dealers Check Beyond Your Credit Score, if you haven't already. Subscribe so you don't miss the next video. Drop your questions in the comments. I read every one. I'll see you in the next one.